If you've seen my video about how the stock market works, you know I said I'd explain more about investing and trading. If you haven't watched that video yet, I recommend you watch it first. It will help you understand this one better. In that video, I mentioned that people can buy stocks either for trading or investing. But what's the difference between the two? Both trading and investing are ways to make money from stocks. The main difference is how long you keep your stocks and how you study them. So let's learn what makes trading and investing different. Starting with trading. Section 1. Trading. Trading means buying and selling things, just like when people buy or sell toys or clothes. In the stock market, trading stocks works the same way. You try to buy a stock when the price is low and sell it when the price goes up, usually within a short time. To trade well, you need to understand something called technical analysis. So, what is technical analysis? You've probably seen stock charts before. They look like a bunch of red and green candles. Each candle shows how the stock price moved during a certain time. When the candle is green, it means the price went up because more people were buying the stock. When the candle is red, it means the price went down because more people were selling it. These charts can look a bit complicated, but here's the simple idea. Traders study these charts to guess when a stock's price might fall or rise again. Technical analysis means looking at past price changes and patterns to try to predict what might happen next, because prices often repeat similar patterns over time. Let's look at an example. Imagine you want to buy a stock, and you're looking at its price chart. The golden rule of trading is simple. Buy when the price is low, and sell when the price is high. That's how you make money. Using your chart, called technical analysis, you think the stock's price is about to stop falling and start going up again. So you wait until the chart shows that the price is starting to rise. Then you buy one share for $20. After some time, the price grows to $25. You check the chart again and think it might fall soon. So you sell it for $25. You just made $5 profit. Later, the stock really does fall to $22. You see signs that it might go up again, so you buy it at $22, wait, and then sell it at $27. Boom, another $5 profit. Sounds easy, right? Well, not really. In real life, trading isn't that simple. Technical analysis helps, but it's not always correct. You're guessing when prices will go up or down. And if your guess is wrong, you can lose money instead of making it. In most cases, you might buy a stock for $20 thinking the price will go up. But instead, it keeps going down. To avoid losing too much money, traders use something called a stop loss. A stop loss means you decide in advance how much you're okay with losing. And if the price drops that low, you sell the stock automatically before it falls more. For example, if you buy a stock for $20 and only want to risk losing $4, you set your stop loss at $16. So if the price drops to $16, your stock is sold right away to limit your loss. After selling, the stock might drop a bit more, then start to rise again. You might think, oh, it's going up again. So you buy it back at $17, hoping to make a profit. But if the price falls again quickly, and you use another stop loss, you'll lose more money. Maybe $4 first, then $5 more, making a $9 total loss. This shows that even with stop loss, trading can still be risky, and prices don't always move the way you expect. Types and markets of trading. There are different types of trading, and each one depends on how long you keep your stocks. Day trading means buying and selling stocks on the same day, aiming to make small profits from quick price changes. Swing trading is when you hold stocks for a few days or weeks, waiting for prices to move up or down to earn a profit. Position trading is more long-term. You keep your stocks for months and try to benefit from big price trends over time. There are also different markets where people can trade. In the stock market, you buy and sell company shares. In the Forex market, traders exchange currencies like dollars, euros, or yen. In the commodity market, people trade items such as gold, silver, oil, or crops. And in the crypto market, Traders buy and sell digital money like Bitcoin, Ethereum, or even meme coins. Now that you know the types of trading, let's move on to the second method, investing. While trading is about making quick money, investing is about growing your money slowly over time. The word investing means buying something that will increase in value and can make you money in the future. If you saw my video about how the stock market works, where I talked about Antonio's Pizzeria, that's an example of investing. In the stock market, investing means buying stocks and holding them for a long time, sometimes for many years or even decades. Investors usually choose strong companies that they believe will grow in value over time. Some of these companies also pay dividends, which means they share part of their profits with the people who invested in them. Fundamental analysis. Unlike trading, investing doesn't focus much on charts or short-term price changes. Instead, it uses something called fundamental analysis. So, what does that mean? Fundamental analysis is about checking how healthy and strong a company is. Basically, finding out if it's a good one to invest in. Investors study a company's financial reports, such as the balance sheet, which shows what the company owns and owes, the income statement, which tells how much money it makes, and the cash flow statement, which shows how money moves in and out of the business. They also look at key numbers like revenue, profit margins, earnings per share, EPS, and return on equity, ROE. By studying all these details, investors can see if a company is growing, earning well, and worth investing in. Because no one wants to put money into a failing business. Now let's look at an example of how investing works. Investing in a toy company. Let's say you want to start investing and you find a company called Happy Toys Incorporated. You do some research and discover that Happy Toys makes fun, creative toys that kids love, and their sales are growing fast. You believe this company has a bright future, so you decide to buy 10 shares at $30 each, which costs you $300 in total. Over time, Happy Toys releases new toy collections that become super popular. The company opens more stores and gets lots of online orders, which helps it make more money. They also pay a dividend. That's extra money companies give to their investors. Happy Toys gives $1 per share each year, so with your 10 shares, you earn $10 per year. Even though the stock price goes up and down sometimes, it mostly keeps rising. You still believe in the company because it keeps creating new toys that people love. After 5 years, the stock price grows to $90 per share, and you decide to sell all your shares. Your $300 investment is now worth $900, giving you a profit of $600. Plus, you also earn $10 per year in dividends for 5 years. That's $50 more. So altogether, you made $650 in total profit from your investment. If investing is so easy, why doesn't everyone do it? You might think investing sounds easy and that anyone can get rich from it. But the truth is, investing takes time and patience. Even famous investors like Warren Buffett needed many years to build their wealth. He started investing when he was 11, became a millionaire at 32, and a billionaire at 56. That's a long time. Most people want quick money, but investing is about growing slowly. Markets of investing. You can invest in many different things, not just stocks. Bonds. You lend money to companies or governments, and they pay you back with interest. Mutual funds. Your money is combined with others and managed by experts who invest for you. ETFs. Exchange-traded funds. Similar to mutual funds, but you can buy and sell them like stocks. Real estate, buying houses or buildings to earn rent and gain value over time. Cryptocurrencies, digital money like Bitcoin or Ethereum that people trade online. Summary: both trading and investing mean buying something and selling it later for a higher price. But the big difference is in the time you hold it and how you study the market. Trading is short-term. You might buy and sell within hours, days, or weeks. Traders use technical analysis, which means studying charts and price movements to guess when prices will go up or down. They don't really care how good the company is, only about the price. Trading can make you money very quickly, but it can also make you lose money just as fast. It's more stressful and risky. Investing is long-term. Investors hold stocks for many years or even decades. They use something called fundamental analysis, which means checking how strong a company is, how much profit it makes, and whether it can keep growing. Investors don't worry about small price changes every day. Investing is usually calmer and safer, and your money can grow slowly over time. For example, if someone bought 100 Apple shares for $300 in 2008 and held them until 2024, their investment would now be worth around $22,000. Some famous traders are Paul Tudor Jones and George Soros, while well-known investors include Warren Buffett and Peter Lynch. You might ask, which makes more money, trading or investing? The answer depends on your goals, how much risk you can take, and how much time you have. If you want to earn money fast and don't mind taking risks, trading might be for you. Traders buy and sell often and must watch prices all day. It's like a full-time job, and you need to understand the market well because losses can happen. If you want a calmer and slower way to grow your money, investing might be better. Investors buy and hold for a long time and let their money grow slowly. It takes patience but is less stressful and can bring steady growth over time. Both trading and investing can make money, but they work in different ways and need different skills. Before you start, learn as much as you can. Otherwise, you'll be gambling without knowing what you're doing and could end up losing your money. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.